So we're going to post it up on the website, and you guys can get into it later if there's anything. And also, one last thing, we do have Kevin Tuttle here. He's our Chief Equity Strategist and the CEO for Tessereact Asset Management. He's the author of the theory. Also, he's going to be sharing with us a little bit later where we're kind of at in this market and some of the cyclical cycles and how maybe the market doesn't necessarily repeat itself, but it does rhyme. We're going to show you some examples, some exciting research that we're working on in here. We're also hoping to get the most updated version of the 100-year market theory out this year, so be on the lookout for that. And of course, we'll keep you guys up to date for those of you that are signed on to our research. So, excuse me, with that, I guess we'll go ahead and get things going. So we originally published the 100-year market theory back in 2003, and it was actually a morning cup of joe that Kevin wrote, and it was titled Ever-Changing Market Dynamics, or Is It? But we originally published it back in 2003, but really we came into this, and Kevin actually got along with the 100-year market theory back in 2001 when he first started analyzing the major bull markets in the stock market. And what we're going to do is I'm going to go through here, and we're going to first start and take a top-down look at this market. And I'm going to explain on a very broad basis and really more of a 30,000 kind of macro foot view how to read this market theory. There's a lot going on the chart right here. And then we're going to turn around and we're going to do more of a bottom-up analysis with it. And we're going to show you some of the smaller cyclical cycles within some of these larger secular time frames. And so we'll just kind of go ahead and get right onto it. Before I get into the actual market theory, there's a couple things that I want to make sure that everybody understands that I just want to get some clarification with. And that is, there's three primary trends that we're going to be talking about today in the cycles. The first one is going to be the secular cycles, and those are the really long-term investment cycles. Those are 5 to 20, 25 years. Not really something that a lot of investors are going to invest with on that time frame just due to the logistical aspect of things. Where probably 90+% of investors live is in the cyclical time frame, or that 1 to 4 year business cycle or economic cycle. We're going to talk a little bit about that, and of course those cyclical time frames make up that larger secular time frame from a bottom-up standpoint. And the secondary cycles, which we're not going to touch base on a lot here, those are a little bit more short-term, and we typically utilize more of the secondary cycles in some of our strategies for some of the hedging techniques and things like that that we use. Also, it's important to clarify that we at Tesseract, we believe that there are three primary trends, which may be a little bit different than what some people think on the street, in the fact that the market typically is in a bullish position or a bearish position. And we believe that there's the interim position, which is a consolidatory channel or a base, where the market really is not going into any primary direction. It's either going up, down, or it's going a combination thereof. So we're going to talk about those three things and really look at how we can measure risk to really, as I said earlier, kind of see that forest through the trees. One final disclosure that I want to make before we get into this, it's always a really popular question that we get, is the price to earnings ratio. The price to earnings ratio that we use is Dr. Robert Shiller. I'm sure most people have heard of him. He has the Shiller Home Index. And the PE that we're using is a 10-year smooth price to earnings ratio. And that's very important. There's a multitude of reasons that we utilize the price to earnings ratio, the 10-year smooth that Dr. Shiller came up with. One of the main ones that I'll share with you is it does a very good job of identifying the business and the economic cycles of the stock market. The final disclosure that I hope everybody can understand is that these bars on this actual chart are monthly bars, so they're very long-term in nature. Again, and this is due to the secular, the macro secular viewpoint. And if one tried to create a trading strategy purely off of this macro secular viewpoint, it's going to be very difficult just based off of investor time horizons. But what it does do, again, is it gives us a phenomenal idea of where the risk lies in the market, so that we can then take more of a bottom-up strategy and come up and create those low-risk, high-reward situations. And we're going to talk a little bit about all that today as we kind of get going. So the theory itself, the main premise of the theory is that excess market valuations, due to extreme price movements upward over extended periods, literally may take years to wane as earnings catch up with prices. And it can simply be seen on a very macro standpoint when you take a look at this chart and you see, let me get my pointer out here. You take a look at this chart and you can see that as we chew off these excess earnings, the market's in a sideways secular consolidation, and that price to earning ratio is getting waned off, and then we get into a secular bull market where we have some excesses in the marketplace. And this process repeats itself over and over. And these are really on relatively large time frames. We're talking 13 to 20 plus years that these happen. So what we've got to do is start to understand what kind of cycle we can look at from a bottom-up perspective. But before we can do that, we really have to try to do a good job of identifying the playing field that we're on and look for some characteristics that can really explain that macro secular, that top-down management technique. And one of the things that you're going to notice, again, first and foremost, is that these secular consolidations are very long periods of time. They can last, like I said, from 13 to 20 years. It's not uncommon for them to last in a shorter period of time like we've seen back here in the Great Depression. But really, the majority of the time, there's going to be very long periods of time. And inside those, you're going to have multiple smaller cyclical trends. One of the things that probably jumps out to everybody out there initially, because of the way we have this chart color-coded, is you can see the price to earnings ratio down here really does a good job as soon as the two numbers you want to look at are 10 and 22. And actually, if you go back through this chart all the way back to 1900, you'll physically see that there's never been a secular or a long-term bull market that's ever taken place since 1900 without the price to earnings ratio first dropping below 10 and then again crossing back under it. And you can identify those points very easily through right here. You've got this, and then we started the 1924 bull market that ran up into, of course, the 1929, and we all remember what happened there. And again, here you can see it happen in 1932. We have one here in 1950, and then you can again see it here in 1982. And of course, the question that everybody asks, where are we at right now? And the current low that was obviously put in 2008, the price to earnings ratio is at 13.32. So based off of this rationale, one would come to a conclusion that we should have some further consolidation before we can have the underlying strength in the economy and the business cycle to really support a macro secular or a multi-year bull market. The other thing that you'll notice with this P to E ratio is you'll notice that you've never, at every bull market has come to an end when that P to E ratio has gotten so overvalued. And again, it goes back to the theory's hypothesis and the fact that those times of economic expansion that last for 10 to 15 to 20 years create a lot of excesses in the marketplace. And when that happens, the market becomes a little bit unhealthy, it becomes a little bit overextended, and you have two options. You can either take an extended period of time, like we see here from 1966 to 1982, to wane off that excess, or unfortunately you could do what they did in the Great Depression and just throw the market out the window, and it can get that excess waned off in 2 years and 10 months. So you can see the result is the same. The excesses were waned off. We've seen the price to earnings ratio come down here below 10. In both cases, like we did from 66 to 82, and just as we did from 29 to 32, the only difference is, obviously, when you have over a 90% sell-off, which is just a complete disaster, it happens a lot faster. So it's, do you want to rip the Band-Aid off really fast and feel a lot of pain, or do you want to do it nice and slow? And you can see the majority of the time in the market, it does take quite a bit of time to wane off. So couple theory observations that if you guys have a pen and paper, you may want to write down just to bring everybody up to speed and make sure that we're all on the same page before we get a little bit further into the theory itself. And that's first that you'll notice that these time frames, these secular time frames, correspond to each other relatively well, and they are based on the previous bull market. So you can see from 1950 to 1966 we had a 16-year secular bull market, and then of course as that excess was created, it took about another 16 years for those earnings and prices to catch up to each other. So we can expect out of this 17-year bull market that happened from 1982 to 2000, which by the way just happened to be the greatest bull market in the history of the stock market. More wealth was created during this time than any period of time in the history back to 1900. 17 years, you could do the math from 2000. So far we're into a 12 plus or about a 13 plus year consolidation in the marketplace. So that's one, is that these time frames are correlated. The other thing that you want to notice is that, again, 22 and 10 are really important numbers on this smooth 10-year price earnings ratio. And that's the fact that since 1900, we've never seen a new bull market created without the P/E dropping below 10. And of course, every time it gets above 22 and then drops back below it, which is the key, we see that that's typically when that bull market stops. Now, when that bull market stops is a lot of times when we create the base or the floor of our actual macro secular channel or our long-term channel. And you can see that that's been done every time the P/Es drop below 22. You have your floor that's created, and you can go back through here and draw it on every single one. That typically is the floor, and those previous highs constitute the top. Now this is a really important point, because some people are going to get in here and they're going to get very detailed. Again, this really is more about the overall idea and the concept of market risk and where it's at. These aren't exact points in the marketplace. You're looking at such a long time frame here. You're looking at secular monthly bars that it's really more of an area than it is an exact science. And we're going to get into from this bottom-up analysis, because a lot of people in here are probably saying, well, we're above the current secular channel resistance right now. And Kevin brings up a good point. A lot of the times these are generational moves. A lot of these investors that started investing down here in 1982, the majority of those guys have a generational mindset that by the time we get over into here into 2013, they've taken this entire time to create those generational mindsets, and it takes a long time for those things to wane off. So it kind of goes back into the theory itself and that straight line thinking. And by straight line thinking, what I really mean is that, just because things were always good from 1982 to 2000, i.e., obviously when mutual funds became extremely popular, modern portfolio theory, capital asset pricing model, or the CAPM asset allocation models became very popular. And by the way, they work very well. Those are phenomenal models. I have nothing against CAPM, modern portfolio theory, any of that stuff. They all work very good as long as the market does what it did from 1982 to 2000. But as everybody in here can probably attest to, since 2000, things have been a little bit challenging for investors. We've seen a low growth, low income kind of area. We've seen massive volatility, and some of those models aren't as good. So that goes back to that straight line thinking. Just because it worked at one moment doesn't mean it's going to work again. And that's where we've really found some value into this and our strategies, being able to plug them up from the bottom up, is that it gives us an idea of where the risk is in the marketplace. And again, history may not repeat itself exactly, but it does rhyme and there are some rhythms to it, and that's what we want to try to find out. So those are really the main points to this theory from a top-down perspective. And I hope everybody gets it. Again, if you guys have some questions, feel free to write them down. What I want to do now is move on to the more bottom-up analysis of this. And what we're going to do is we have done some research into this theory. Again, we're publishing a new one this year with the updated research, but we've identified some commonalities in the theory itself inside these secular channels. And of course, that's what we're all interested in, because inside these secular channels is where most of us live. That's the cyclical marketplace, the 1 to 4 year time frame of investors. And what we found is that there's some halfway completed indicators. Those indicators let us know we're halfway through the channel, so we can have a good guesstimate as to how much longer we're going to be in this macro secular consolidatory phase. And it also gives us an idea, if we know we're halfway, what are some of the similarities in that channel that I can look for so I may be able to expect or at least plan and start to begin my education to think through my potential strategies moving forward. And the first thing that we look at is the deepest sell-off within the channel. That deepest sell-off, which typically is the second cyclical bear market, constitutes the halfway indicator. And we confirm that because usually that second sell-off is followed by the greatest cyclical bull market. This has happened in every single instance in the channel that we've identified. And that greatest cyclical bull market, the irrational exuberance, as Greenspan would put it, that is created by that huge bull market off of that top and the amount of emotions and, again, the generational memory, just like from 82 to 2000, the market went straight up. We had the tech bubble. It fell down in 03, and from 03 it ran up 70, 80, 90%, and people immediately went right back into that straight line thinking, and they said, hey, here we go to the top. We're going to pop topside. We're going to get back into this asset allocation. We're going to get back into modern portfolio theory. We're going to get back into CAPM, and we're going to keep on rolling. And unfortunately, the markets just aren't strong enough. Those business cycles aren't ready, so it creates a false breakout, and that can be one of the most disheartening things for investors. That's how we know we're halfway. Now, once we do that, what we've identified is some similarities in the second half of that cyclical channel. First and foremost, we know that the cycles are smaller. In other words, our trend duration isn't quite as long. We'll see shorter cyclical trends. We're also, the good news is we're going to see smaller cyclical downturns. And that's the good news. We shouldn't and we don't expect to see, not saying we won't, anything can happen obviously. We don't really fully expect to see a downturn as deep as we did in 2008. It hasn't happened since, and it would be the first time that it's happened since 1900 if it did happen now. The most frustrating part of these channels is that towards the end there's usually a cyclical channel, and this is where the amount of investor frustration just boils over. It goes over the top, and a perfect representation of this is from the 1966 to 1982 channel. In 1979, Time magazine came out and they wrote an article, and it was titled "The Death of Stocks." And at that point, the investor frustration was so large, it was so huge. Time magazine actually published the cover of their 1979 magazine said the death of stocks. Stocks are over. And of course, what followed that publication was the greatest bull market in the history of the United States. And that was due to that frustration, that investor psychology. People get very frustrated. So let's go through and let's look at some of these channels, and let's start to identify some of these halfway indicators. And it looks like our lines are a little bit off on these pictures. You'll have to excuse me. But you can see this is actually the halfway indicator here, right here. And you'll notice it's the deepest bull market. But it's also followed by the deepest bear market. It's also followed by the greatest bull market, 107.5%. And after it was followed by 107.5%, we also seen we didn't have quite as deep drawdowns, but more importantly, what we saw that irrational exuberance. We saw these pops of the cyclical channel or the secular channel happened over and over again. This one here is in the nature of probably almost 20%. It went above the secular channel before it came back in, and this again is due to a lot of that straight line thinking. We see that the cyclical channels, the time frame of these are a little bit less than they were on the first half of the channel. And of course you can see the downturns weren't quite as large. There was a couple more downturns, they weren't quite as large. And at the very end we see an actual cyclical channel that took place. And that cyclical channel in this case lasted for 1 year and 8 months. So again, that frustration kind of tips over. So let's take a look at the next secular channel. Now this one's a little bit different. It's our contention that the difference in this one lies because this is obviously post-Great Depression and the massive amount of watershed that was created during that event through some of the similarities of this channel off with the other ones, but you will notice some of the main points of this channel are still the same. And again, you're going to have to excuse the lines here. It looks like for whatever reason a couple things have shifted, but this is actually the halfway point in this market. So you can see you have a 5 years and about a 7 year. And what happens is you were followed by the greatest bull market, which was 130% here. Again, you had a pop topside of the market, that irrational exuberance happened. A little bit wavy here because, again, our cyclical channels weren't quite as small. They were a little bit larger in this one, but the downturn wasn't near what the downturn in the middle was. So you can see these similarities happening in every channel. And again, towards the end, you have this cyclical channel, which you can see is highlighted in blue. Which brings us to the channel from 1966 to 1982. You've probably seen a lot of people talk about the 1966 to 1982 channel and relate it to the one that we're in. There's been a lot of comparisons in that channel. But again, one of the things that you'll notice here is you have the halfway point right here, which was the largest bear market in that. It was followed by the greatest bull market in that cycle. It also had that irrational exuberance that happened, and that irrational exuberance popped at topside. It clearly did not have a sell-off quite as deep as we did in the previous two bear markets of that channel. And then again, you have this sideways consolidation, which we have highlighted here in this blue area. You can see it here. Technically speaking, some people would consider this to be a little bit larger consolidation. But at the end of the day, you've got a 2-year cyclical channel towards the end. Really, almost the investors, clearly, they almost give up at that point, and they're ready to stop investing in stocks. And of course, as most people in here know, when that time happens is about when you want to make sure that you're investing in stocks. So it brings us to the question, where are we at now? What does all this mean currently? And I want to show you something. You can see the halfway point here. We believe, it's our contention, the halfway point was in 2008. It was the largest cyclical bear market in history. By the way, it was the largest cyclical bear market in history, 54.5%, but it was also the largest in this channel. It's also followed by 100+%. The run's not done yet. There's a lot of people in here today probably asking themselves, is the run done? Are we going to get out of here? What's going to go on? I'm going to turn it over to Kevin in just a few short minutes, and he's going to talk a little bit about that and show you some comparisons of the trends within trends. We do expect, obviously, you can see that irrational exuberance has popped the top of this secular channel. The other thing is the first half was 8 years. Here we are moving into the second half is about another 8 years. That puts us out, and again, this isn't an exact science, give or take a few months. These are monthly and very secular channels. Right around 2016 is when we can expect to start to begin to work our way out of this secular channel, which of course will be predicated by that price to earnings ratio, and we'll see all these things start to kind of line up, and ideally we'd start to see the underlyings and the underpinnings of the economy start to strengthen as well. We don't expect to see as deep of a cyclical sell-off. If we do see some coming forward, we think they're going to be a little bit more shallow. Again, we do expect to have a cyclical channel which could last anywhere from 1 year to 3 years towards the end of this thing. Some of these cyclical channels are 12 to 15% in length, and the market can bounce around back and forth in between there for 3 years at a time, obviously causing a great amount of frustration for investors and making things a little bit more difficult. Those nimble portfolios anymore are extremely important moving forward. You must be liquid. You've got to be nimble. Those are two huge things that you can get looking at these similarities. So that's really kind of where we're at as far as the bottom-up analysis from the 100-year market theory. What I'm going to do now is I'm actually going to turn it over to Kevin Tuttle, and he's going to spend a few minutes going over kind of where we're at today in the market and drawing some comparisons in history again. So I'll turn it over to him. As soon as he's done, I'll grab it back, and don't forget we're going to open this up to a Q&A session here in about 10 minutes.
Josh, thank you. Thank you. Josh does a great job as a partner in the firm, and he's been alongside going through this 100-year market theory for years on end. He does a really good job explaining really the long-short view of where people need to be and how people need to invest. And as he said, we're going to go ahead and, excuse me, I'm going to show my screen here. we're going to go ahead and talk about some similarities and really where everybody lives. He mentioned earlier that there's the generational moves, and that's the straight line thinking, where people get into a set, and it's always been that way, and it's going to be that way going forward. But as we know, in year 2000, and the tech bubble was the first shot across the bow, that things have changed. And the buy and hope theory, the buy and pray, the buy and hold theory that people were investing with is no longer valid. And the premise behind the theory is really to ascertain why that is, because you've entered a secular channel. But again, as we all know, and all the people on here know, is that, excuse me, I have to reset my presentation slide, so bear with me. I think this should be better. Give me 1 second. And as people know, that we don't live in the secular time frame where that is all that you want to invest in. In fact, if you're in a channel and that's all you're going to live by, therefore just stand pat and put your money under the mattress. So what is it that we can do? Well, we have to ascertain when the cyclical channels happen within the larger secular channels. And I seem to be having an issue with my slides. So what I'm going to do is I'm just going to stop showing both. I'm going to bring this over. And we're just going to work with the slide as it is in the presentation. So I'm just going to show you that. So what we found is that there's many similarities, and the title, I think Josh put a title on to the presentation today, is from Mark Twain, and we use that tongue-in-cheek in the fact that history does not repeat, it does rhyme. So when we look at where we're in, we have to understand really what a cycle will look like. What I've done is taken a snapshot of a cyclical cycle within a secular bull market. This was in the 1982 to the year 2000 secular bull market. That run, as we all know, was 18 years. And during that period of time, there was a lot of watersheds that transpired, but most of them relatively small except one. So I'm going to show you this one because it resonates with me, and there are some similarities to some things that have happened. But what you'll see is in a normal cycle, in September of 1987 was after a nice cyclical bull run within that secular channel, and then there was a correction. Well, it was a watershed, really. And that correction was very, very deep. And as you can see, and I hope that you can see here, I'm going to put on the highlighter, that the spotlight. So you can see down here, you had this quite watershed. You had an area point in time where there was consolidation. And once it was waned off, people started buying again. And what you'll notice on this, if we switch slides, let me see if I can go down to the next slide. I'm not on the presentation mode, so I have to be able to maneuver this. Bear with me 1 second. I'm challenged here. I'm technically challenged with my presentation mode. You have to forgive me for a second. So what we're going to talk about is that after you had a consolidation phase down towards the bottom, you started in your bull phase. And as we move forward, you can see this is the typical trend that it would follow. And as the typical trend would come up, you have your parabolic move towards the end. And once you got towards the end, you entered the next cyclical, on a smaller basis, cyclical consolidation range. Now, a lot of people on Wall Street believe that there's only two stages. There's bullish and there's bearish, and we don't happen to believe that, and it's really based on the 100-year market theory and a lot of things that we have personally found out in our research, and that you will find you will have an area at the top and an area at the bottom where it will be a consolidation. In that consolidation, you will either continue north after you consolidate for a while, or you will then again begin a new channel, and it would go into a bearish channel. So this one is an example of where you end one cycle with a straight shot across the bow. That's 1987. You have a small consolidation at the bottom, and then it starts to go up. Now, once this consolidation was over, at the end of every move, most people, and I think that the people that are on this webinar probably realize that end of move typically becomes somewhat parabolic, whereas you can see the slope of the curve indicates on a higher point. So when we look at that, I wanted to find some similarities into what the market is doing today. So what I did is I threw out today's market. So what you see underneath is the start of our market and a consolidation, and underneath, directly below the 1987 crash, is the Greece debacle. So it gives you some semblance of some time analogies of where we're at. So we're talking about back in 2011, August to be specific of 2011, we really had that break. And then you'll see that it consolidated sideways, and I'll just move this up, consolidated sideways, and then started another move higher. And when you look at it, and you look at the different areas that you have, you can see that the consolidations are very similar. Now, as we get closer and we compare these, and I lay them directly on top of each other, that curve is identical for both of the slopes. And as you can see where we are today, this was printed yesterday, I think. So yes, it is. That's yesterday's move. And if I lay this over in correlation from the beginning into the end, that's where we're currently at in today's market. What's also noticeable is the volatility peaks. You can see all the pivots over here. It says these are the pivot points. So you can see that the pivots are at a much higher stance, and the troughs are much lower or continuing on the bottom side of that curve. So it's very similar nature, again, rhyming with history, in a typical cyclical cycle, and how those cyclical cycles end. The only difference is we all know on this webinar, since 2009 and the last 4 years has been more volatile than we have seen since the late 70s, where you're getting 19 to 20% vacillations in the market per annum. That's unheard of. Those are typically considered new bear markets. So I want to leave it at that and tell you that this is not to predict what's going to happen tomorrow. I just want to let you know that when these areas happen, if you're aware of them, if you're aware of your stance that is around you, you'll be able to adjust as time moves forward, versus the old buy and hope theory where it says, well, I should be in this asset allocation stance because this is what it tells me to do based on the time horizon that I have with the rest of my investment career. Yet on the same fashion, risk to a lot of people is unknown until it already happens. But if you can evaluate where you are, you can actually evaluate risk a lot better than somebody telling you that you have 15 years left and you need to be in a 60-40 stance. So it's a matter of what is it you use as an underlying foundation to be able to invest with your own assets. This theory is not without its shortcomings, and I know that. Nothing's perfect. No asset allocation program is perfect, and no theory that you stand on is perfect. But if the theory is something that can adjust with you to determine where you should put more at risk or less at risk, put the risk on trade as they talk about, or take that risk trade off, this theory will help you do such and be able to move forward. And we've been managing assets on this theory, obviously, since even before it got published. The theory was actually in inception, and we birthed the theory back in 2001. The chart came into inception in 2002. By the time I got my lazy butt around to writing everything down, it didn't get published until 2003. So that's where I think is the benefit. If we can offer you anything, it's the idea behind a different way to view how you manage your assets other than Ibbotson's model. Not that there's anything wrong with Ibbotson. Josh, I'm going to give it back to you, and hopefully I'm going to stay on. I'm going to switch my screen over to a charting screen, and I'd love to have any questions that anybody has where we're at currently today, or anything that people want to ask about the theory. I'd love to answer.
All right, thanks, Kevin. It's so insightful when you have a chance to look back at history a little bit and see how this market rhymes. I think we're running a little bit late here, but just right before we get into questions, I wanted to give everybody the opportunity to be able to go download the 100-year market theory. If you guys want to, it's free. And like I said, we're going to be recording this webinar, so we'll have it up on our website soon. You can just go to 100yeartheory.com and feel free to download it there. You can get the theory, you can download it, you can read it. You can also view the chart there. We've just launched our 10-year anniversary chart with all the updated data. It's really cool. We've got it designed like a stock certificate. And of course, if you want a free one, we've got a small 8.5 by 11 digital copy that you can always, of course, get for free as well. So Feel free to jump over there and check things out. In the meantime, right before we open up to questions, I just wanted to make some people aware of some of the changes that we've had here at Tesseract in the first quarter. I know we have some clients in here as well as a lot of our research subscribers who've been asking a lot about our products. We've been working really hard on top of this series and with some of our quantitative metrics and our cyclical trend indicator in developing some products that are really going to make sense for today's investor and the challenges that they have moving forward. And that's, of course, the low growth, the smaller cyclical cycles like we've talked about, the ability to be much more nimble, and really more importantly, as we see those cyclical consolidations towards the end of these channels, and we also see these downturns, principal protection becomes a huge part of what we're doing here. Like I said, we don't expect a 2008, but we do expect some sell-offs, and it's really important, especially this late in the cycle. Most investors are pretty beat up, and they're pretty done with having that no-growth period, so they want to at least protect what they have. And we've really built these for this theory based on this series as its underpinnings and really based on today's market environment. So we've had a lot of questions about them. I just want to let you guys know. I think Jessica's got them up on the website today. You could go to InvestTam and check them out. And of course, I'll just give you a brief rundown. We've got our long only, which is a systematic all-weather growth ETF portfolio. It's SAGE. It's a separately managed account. It's a core satellite strategy that's designed to combat that low-growth, kind of high volatile market. It's really what it is it follows the business cycles very well of the economy and rotates out of different sectors and industry groups as they come into fashion and out of fashion, as Kevin says, that risk on, risk off. And then we've got our big, which is probably one of the most exciting strategies as far as I'm concerned. It's an income and growth strategy that does offer a hedge in the downside, but it also offers a current yield of about 5.5%. And all the back test results on it going back through 2008 to 2006, we're getting about 11% annual return on that, with a third of the standard deviation of the market. So, and then of course our long-short hedge fund. So I'm going to open it up now to questions, and if you guys have a question, feel free to type it in the chat section, or if you have your microphone on. This is the first time I've used GoToMeeting, but I'll make my best attempt to put you on air and get you live. And Kevin, you're still here with us, aren't you?
I am. I'm still here.
Okay. So if anybody has any questions, I guess raise your hand or type it in the chat section for us, and we'll see if we can get any of these questions answered. Stephen asks, what is the minimum account size to open? It's a good question, Stephen. We don't take a lot of private clients. Our main focus is with institutions and other registered investment advisors. As I said earlier on in the presentation, we've really focused on as 2008 and things have changed. We've really kind of evolved into being a third-party money manager for other registered investment advisors as well as institutions that are looking to really fulfill those other fiduciary responsibilities to their clients and grow those books of business. But we're more than happy to talk to you. It depends, obviously, on what of the products it is. Obviously, for our hedge fund, the minimum account size is much larger. For some of the other SMA, Steve, the minimum account size is typically around $150,000. So if you have any interest, feel free to give us a buzz. We're obviously more than happy to talk to anybody about that kind of stuff. Does anybody else have any questions? I don't know if somebody's raising their hand. Let me see if I can figure out how this thing works. All right, Ann, I've got you on. It looks like you have a question there. No? Let's see. Nope. Anybody else have any questions? I see a couple coming through here. Okay, I've got one from Sebastian. Sebastian, thanks. And Kevin, this might be a good one for you to answer. Sebastian's asking, must the Shiller price-to-earnings ratio be under 10 at month's end? That may be a good question for you to answer and go into a little more detail on.
Yeah. So let's step back for a second and step one step above the box. You know, a lot of people believe, let's say that you're a complete technician, right? It's about the pinpoint, the exact moment that something happens is that sets your trigger off. When we look at it, it's a generalistic view because when you're looking at the Shiller 10, as Josh was explaining earlier, is 10-year smooth. So it'd be very difficult to say that pinpointing that to a particular moment in time is that's going to kick it off, and we're going to switch and go bullish. So let me tell you really what I think your question is. What I think your question is how do you know, right? How do you know when the channel's done? Because one of the big things is when we first published the theory in 2003, we were almost ostracized out of the industry, laughed. When we said that the market will channel for the next 18 years, we were the laughing stock of Wall Street. But you got to stick to your guns. You've got to know what the theory is about. And then in 2007, the market broke top. When it broke top of the channel, which at that point in time we only had at 12,000, as we all know, went to 14. So in 07, so we saw that move, and everybody said, "Well, hey, you're wrong. It's going up." And we said, "Well, that's not really the case because most of them do break top at least once, if not twice." And yet, not one time in 100 years, not once, out of any secular channel or any move that you've ever seen, have you started a new secular bull market after a 4-year cyclical bull run. There is always a consolidation period of 18 months to as much as 3 years of a consolidation prior to a new beginning. So there's a couple things that throws into play. So I'll go back to your question. The PE multiple that Shiller uses indicates valuation of the market in general. As everybody on this call probably knows right now, the price-earnings multiple is nothing more than the concept of how much money you're willing to pay for $1 in earnings. So if the S&P right now is at 15, then you're willing to pay $15 for every dollar of earnings that you're going to get on the street. And as we all know, during the tech bubble, we saw as high as 47. People were willing to pay astronomical amounts of money for no earnings, essentially. So really that's what you're looking for. When you see that shift, it's not just about the drop below 10. And if you look at the chart carefully, you'll see that the Shiller PE has dropped to 13.4 at one point in time. Or I think it was 13.6. I don't have it up in front of me.
13.36, I think.
Thank you. So that was close enough, 4, right? So when we're looking at that, what we have to ascertain out of that is that it's the change in trend of the direction of the PE after it drops below that 10 level. And when that change comes, you will get that confirmation. So if you get both a cyclical 1 to 5 year bear market or consolidation phase over 18 months, a 36-month period of time, and the price earnings multiple is below, and you're heading back towards the top of the channel, and you met not only your halfway point, but you're relatively the same on the other point on the other side, now you have a weight of evidence to ascertain that you probably and most likely could be converting into a secular bull market. And I don't want to take too long on the question, but I want to leave one thing resonating with you, and that is that, again, this theory is not without its shortcomings. If anybody on this call thinks that if I add those 3 things together, I'll pick the next secular bull market, you're absolutely insane. What will really happen is that you get to use that as a weight of evidence, and if you follow along in your cyclical bull market trends, the smaller ones, the 1 to 4 years, then if I'm wrong, I'm still right, meaning that if the theory is wrong and this is a continuation north and this is an anomaly and it's going to happen, it's never happened before, that's still fine because you're still in that cyclical bull mode, and we go topside, you haven't converted to bull neutral, or even a bearish stance yet. So therefore, even if you're right, you're wrong. You're not basing it on whether or not your allocation should be properly measured on what your age is. And I think that's what we take away from it.
Yeah, thanks, Kevin. Steven's got another great question that I'll bat right back over into your court, Kev. He's talking a little bit about, and you can see it there in the question section, but Steven's basically asking, for those of you that may not see it, relative to the theory, what do taxes, government debt, really overall geopolitical issues play a role in hindering the progress or the ability to have this breakout through 2016 as we kind of expect for these cars to fall into place? Really kind of what he's getting at is, with everything going on in the world, obviously quantitative easing affecting the valuations of the marketplace and the overall economy, and you know, the U.S. getting energy independent, and I think I'm pretty right on here. Correct me if I'm off, Stephen, but is any of this stuff, is it different this time? Basically, is I think the question that you're asking. Could you shed some light on that, Kev?
Sure. Yeah, actually, Stephen, it's a great question, and one of my most favorite questions that Josh and I get asked all the time. We go all over the country doing this presentation and talking about the philosophy of change for people's and RIAs and individuals' mindsets, and how to readjust and how to make sure that you're doing the right thing and measuring risk. And the constant question we get, that every time, it's guaranteed, I swear every time, and it's the only guarantee I'll use, is that someone will raise their hand and say, but isn't it different this time? Yeah, it's different every time. So the effects of what's happening in the marketplace will change the landscape, let's say, of the market in a shorter period of time. And I'll tell you right now, this is my own personal opinion. Do not take this to the bank. Please, you can tell me if I'm wrong, but the only reason that the market is where it is because of QE infinity. There is too many underlying issues that are dragging apart the underpinnings of this market, and yet the market continues to go higher. I mean, I pump enough money into or enough fuel into a broken engine, I'll allow that engine to run for a very long time until it finally just explodes, right? You can run your engine without oil, but if you keep pumping it with jet fuel instead of regular unleaded gasoline, you will keep that thing running until you blow all the pistons. So my point to you is, yes, taxes, absolutely. Great effect on GDP. I believe that, and I'm not giving you a political affiliation. You know, I believe that taxes are a great effect. Do I believe that the dollar and the geopolitical issues are having an effect on this marketplace? I do, but not as adversely as they should be. I mean, with the debacle that was happening in the European Union after Greece, and I'll be completely open and honest with you, after the Greece debacle on August 8th, I called the next cyclical bear market with, I can stand in front of you today and say, with egg on my face. Because when that broke, I felt that that was the starting point of the third cyclical bear market in this channel that we've been in. And yet, you know, a month later, they announced another QE, and off we went again. And so we had to readjust where we stood, and we put the bullish stance back on instead of being bearish or in a neutral stance, and we have to adjust accordingly. So yes, is there an effect, and is it great? It is. But one thing that you'll be able to read is knowing that if that trend changes, and what I mean by the trend, I don't mean the technical trend of the market necessarily itself, but risk, the assessment of where risk actually lies, then you have to make an adjust accordingly. So there is no way we should be 30% above the neckline of what we call the 12,000 top on the Dow. But if you also notice, and looking back, is the S&P is right at 1550, 1575, right where the tops have been over the last 12 years.
All right, thanks, Kev. I guess if nobody else has any other questions, we'll go ahead and shut it down, but we are here to answer any questions that you guys have. We don't have to go. I just want to be respectful of everybody's time, and really, again, I just want to say thanks for taking a look at the theory. I hope everybody in here learned a couple things, and again, if there's any other thing that we can do with regards to anything, we're here. One of our core philosophies here at TAM is education and transparency. So whether you're a client or not, if you have any questions, feel free to reach out to us, and we'd be very happy to talk to you and listen to your situation. I guess Steven says he has one more. Do you fear when the Fed starts to pull out? Absolutely would be my answer. I don't. I am a little bit afraid of that. I think if you weren't afraid of that, you've got a lot. You're a lot tougher than I am, I guess. But I think that's the ultimate question. I mean, that's the million-dollar question, really, Stephen. Is how is the Fed going to turn off the spigot? Because it's very clear, based on history, that it's a lot easier to turn it on than it is to turn it off. And of course, the trick is turning that spigot off and doing it with as soft a landing as possible. And maybe they have some things up their sleeve, maybe they don't. Things could get a little bumpy or go straight down, but we're absolutely afraid of that.
We know it.
Steve also asked, do you think there's any value in putting gold price in the chart? I guess I'll take a stab at it, Kevin. You can correct me if I'm wrong, but I really don't. From my viewpoint, I wouldn't see any value in putting a gold price in this chart going back to 1900. I sure wouldn't.
I think and I'll tag on to what Josh said. This is Kevin again, and I get asked the question a lot, and I don't want to be specific about gold. There's been a lot of questions lately about gold, obviously, because of the watershed 200 points that it's eaten in the last week. But really what a lot of people should be more concerned about is a cycle, a commodity cycle. And there's a lot of theories out there based on a commodity cycle and how that commodity cycle associates itself to the market. Martin Pring, who I've actually had the pleasure of not only reading in my 25 years of doing this, have met and have discussed in great lengths about his thoughts on a commodity cycle and how that relates to the cycle in the stock market. And I believe there is a correlation, but for the intents and purposes of this, that correlation is used to also help ascertain when that will end. I personally have not found an absolute correlation that I'm comfortable with. That doesn't mean Martin Pring is wrong. It means that I haven't done enough work to actually get a correlation that I could come out and say, yes, I think that it's important.
All right, guys. Kevin, hey, thanks a lot. And again, thank you to everybody that joined us today. If you guys have any questions, feel free to give us a shout, give us a buzz. If not, look forward to seeing you on our research, and hopefully we'll see you guys around soon. So have a great day, guys, and we'll see you guys around.